The US economy is holding up. Two closely watched reports, retail sales and industrial production, both came in consistent with steady growth, giving investors and policymakers a reason to exhale, at least for now. Start with the consumer. Retail sales measure how much households are spending at stores, restaurants, and online. That number matters because consumer spending drives roughly 2/3 of all US economic activity. When people are still opening their wallets, it usually means they feel reasonably secure about their jobs and finances. The latest reading suggests that is still the case. On the factory side, industrial production tracks output at manufacturers, mines, and utilities. When that figure holds up, it tells you businesses are still filling orders and keeping workers on the floor. That is good news for employment and for the broader income picture across the country. Taken together, the two reports sketch an economy that has not cracked, not yet, despite months of elevated borrowing costs. The Federal Reserve has kept interest rates at a restrictive level as part of its campaign to pull inflation back down to its 2% target. The central question in markets has been whether that pressure would eventually push consumers to pull back sharply or force manufacturers to cut production. So far, the answer appears to be no. But here is the tension. Strong consumer spending can keep prices elevated, which is exactly what the Fed is trying to prevent. Solid retail numbers may give policymakers less reason to start cutting rates. At the same time, healthy factory output supports jobs and wages, and the Fed watches those trends carefully too. The central bank is trying to thread a needle, slow the economy enough to cool inflation, but not so much that it tips into a downturn. For markets, the implications are straightforward. Rate expectations drive a lot of asset prices. Stocks, bonds, and the dollar all move when investors shift their bets on what the Fed will do next. A resilient economy tends to push back the timeline for rate cuts, which can weigh on stocks and keep bond yields elevated. A softer economy does the opposite. The next big tests will come from the jobs report and fresh inflation data. Those two readings will do more than anything else to clarify whether this resilience carries into the second half of the year, or whether the cracks are just starting to form beneath the surface. The practical takeaway: watch the next jobs and inflation prints closely. If consumer spending stays firm and factories keep running, the Fed has little reason to move quickly. That means borrowing costs stay higher for longer. Something worth factoring into any interest rate sensitive position. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.